Good morning, everybody. Good afternoon. It's a little bit past noon here. I'm Joe Lucey. I'm Certified Financial Planner, CEO of Secured Retirement, and welcome to this week's Market Huddle. You know, I've started to notice, and you probably have too, that things are starting to get a little bit, more expensive lately. And I don't think it's just an illusion. In fact, for the first time in a long time, I think that inflation is a real threat to anybody that's getting ready to retire. According to a recent report, the U.S. is on the verge of one of the worst bouts of inflation in decades, something we really haven't seen a whole lot of since, even the 80s. And what this means is it could spell real problems for anybody that's in or nearing retirement right now. So this week on this week's Market Huddle, I want to talk about inflation and what you can do to protect yourself around it, and what you want to be thinking about with your retirement planning. Now, as normal, at the end of today's presentation, whether you're a client or not a client, if you'd like to schedule some time, get a second opinion about how to make sure you're planning around inflation, how to bring that into your retirement planning, we'll make sure that everybody has an opportunity to sit down with us and go over that. So, as I said, I think that inflation is really starting to come back. It's starting to rear its ugly head a little bit, and it's actually coming back even faster than many economists predicted. I mean, it's not a surprise really to anybody after the dramatic shutdown we had with COVID and everything that we wouldn't start to see some inflation. But April's inflationary numbers here are 4.2%. Well, that's the highest jump we've seen since 2008. We have May's numbers that are going to be coming out this Thursday. I'm a little worried, what could happen if we start to see some really high numbers. In fact, I saw Janet Yellen here this morning from the Federal Reserve saying, hey, you know what, a little bit higher interest rates wouldn't be a bad thing. So I think that they're starting to tell us that things might be going a little faster than they want. Now, every month this year, we have started to see these numbers, inflation numbers, accelerate. And economists and expert, there's a gentleman out there by the name of Peter Schiff. And here's what he says. If you extrapolate the year-to-date monthly trend for the first 4 months of this year, going through the April numbers, he says we're on target for a 20% increase in consumer prices for 2021. Now, that says that if you look at inflation as maybe a tax, it could really spell some problems for retirees or somebody getting ready to retire, especially if we are on a fixed bucket. I'm going to get the presentation going here. But today, that's what we're going to talk about. We're going to talk a little bit about what inflation could mean. What do you need to be doing with your retirement planning, and how do we make sure that we're protecting ourselves from that? And what are some potential things we might want to be thinking about? So I'm going to turn this off here. Most of you have joined us before. You know that we have a disclaimer here that they asked me to share with you. I'm going to kind of read through it real quickly, but just understand what it really says here is that I do not work for the federal government. I am not a tax I can't interpret tax code. I'm not a CPA. I'm not an accountant. Also, I don't work for the Social Security Administration. I am not an attorney if we get into anything legal, which I don't think we're going to do today. But that's what this means, and just keep this as a lot of the stuff we're talking about here today on this week's Market Huddle are somewhat real-time things, and we don't really know. What I'm trying to say here is that we're talking about real-time data, so just understand that what we're talking about here is kind of forward-looking, and we may not necessarily know how this is all going to play out. So, oops. Boy, somebody let me have the IT here again, and that doesn't always work out. So, all right, let's get to this. Okay, so what is inflation? Inflation here is basically it's the cost that things are that we pay for things. It's been poised, I think, for a comeback here. since we started to recover. In fact, the COVID-19, the lockdowns that occurred last year, our economy was basically turned upside down very rapidly, very quickly. As you know, April, the 2020 unemployment numbers peaked at 23 million. 23 million people. It was an unemployment rate of 14.7%. As a result of all this, the U.S. consumer ended up spending in 2020 $500 billion less in 2020 than they had spent in 2019. In fact, some of what have happened there. A lot of companies have gone belly up. Workers were laid off. Manufacturers halted. We've had problems getting things like microchips that says that, while we've got cars to sell, we may not be able to get the chips. In fact, I saw an article here talking the other day about that there is a whole new group of vehicles that are being sold right now without some of the emergency procedures, the airbags and such, because they aren't getting the chips, but yet families are willing to take those. And basically, as a result of all the things that happen here with COVID, we injected trillions and trillions of dollars. It's expected to exceed about $6 trillion in COVID relief. And what that really did is it set the table here for what I think we're going to start to experience. We did the very first market huddle, which we've been doing pretty much weekly, except for, a couple long weekends or something, since March 23rd. On March 23rd, the Dow Jones bottomed out at 18,500. That's the day we did our very first market huddle. Currently, we've got almost a double, 34,600. The markets are doing well. All of this stimulus out there. Now, we got Americans getting vaccinated. Businesses are starting to reopen. We're starting to see a lot of this where inflation is really starting to come and rear its head. People are willing to buy things. They're paying for things that if they can get their hands on it, that because of some of the shortage in the surplus chains and such, all of this is starting to raise some things. And again, back in April, the numbers released here last March showed a 4.2 inflation rate in April. That's numbers we have not seen going back to 2008. We've got another set of numbers coming out here next Thursday. And what it really does, it puts a real disadvantage for somebody that's in or near retirement. Inflation starts to take away your purchasing power on things, not just gasoline and groceries, etc., but all those other areas. And in addition to that, as we go through this here today, I think that there's other areas of inflation that if I'm retired or nearing retirement, I got to start looking at what is going to happen to our tax rates. What's going to happen with the cost of health care or long-term care. And all of that we want to be bringing into our retirement planning. Keep in mind, families always hire us here at Secure Retirement because, number one, it's about making sure we can maintain our lifestyle. Inflation can erode that lifestyle, what you're able to spend if it goes too high. Number two, it's about reducing taxes. Well, tax rates are going higher. I can't think of a better time in 40 years to really get focused on this in 2021, because I think our limited opportunity that we've had here that we've enjoyed for a few years is starting to go away. And then the third thing is we'll help you grow your wealth, but never at the compromise of the lifestyle or helping you reduce taxes. CNBC tells us on May 12th, they said the increase in the annual headline rate of 4.2% CPA was the fastest since 2008, and the monthly gain in core inflation was the largest since 1981. Think about that. We're talking 40 years. And so I think that we could really see some disruption in the market as we go through some of these areas, especially if I'm right, that we're going to see a little bit of inflation now for the next few months and really start to see that. You might be asking yourself, is now a good time to rebalance our portfolio? Is now a good time to look at adjusting things to reduce taxes? Are there things we can do to protect the market volatility that we could possibly see? Or are we sitting on some money that we're trying to keep away from market volatility, some of that safer money? Are there ways that we can keep up with inflation a little bit better than the very low interest rates we've had in CD rates and savings? So Go back to the 1970s and 80s. I'll start with this. How many of you remember the double-digit mortgage rates in 1980s or late 70s? I looked at some numbers. In 1980, the top mortgage rate hit 18.5%. A 30-year note for your home was 18.5. I remember my uncle and dad having a discussion about the house they were buying, and there was a balloon after several years, and what a great deal this double-digit mortgage was going to be so that they could purchase a house. Now, today, did you ever think back in 1980 you'd see mortgage rates, 30-year mortgage rates at less than 3%? In fact, if I talk to the average retiree coming in the office today, the average inflation in 1981, when you were 25 years old, was 14%. And high inflation devastated folks that were retiring in 1966 to 1985. Keep in mind, that was a period of time when many more families still had more mailbox income. We were talking about Social Security, which is out there, but there was more pensions back in those days. Now, according to Robert Schiller, who's a Yale finance professor, he said investors who expecting a 6 to 7% rate of return on their stocks were actually netting 0%. That's what, that's stagflation. And not only did they average that for a short period of time, from 1966 to 1985, for 20 years, that's what the average retiree saw. So the double-digit inflation, if it were to resurface today, again, back to Robert Schiller here, this Yale professor, he's saying, get ready, because with the low interest rate environment that we have now compared to the 6 to 7% or better returns in that fixed income, we could really be in trouble here. Ran through some numbers. The average cost of a new car in 1970, as you can see here, was $3,450. Not bad, but I know a lot of you probably spend that or more on vacations once a year. Go to 1980, it was $7,200. You're probably saying, well, Joe, what is it today? Well, today, the average cost of a vehicle is $38,723. That's inflation there. If you look at the average gallon of gas in 1970, 36 cents. 36 cents. It would cost me less than $10 to fill up my tank. 1980, it's $1.19, and today's prices, Minnesota's average right now, $2.73. In fact, there's areas around the country, New York, California. California is currently just under $4, $3.91. We need to make sure that we're thinking of ways that we can make sure that we're protecting our retirement from this inflation. And again, it's been easy, I think, for my industry. Planning around inflation has not been as important since 2008. But here we come, and I think that it's really time to start thinking about this, because an inflation rate of 1%, 2%, 3%, it doesn't seem like a whole lot, but over time it really starts to erode what you can able to spend. Ronald Reagan called the inflation the silent killer, and I think that's what it is, because it can dramatically change your spending habits in retirement. Value of your savings becomes less and less, especially in a low interest rate environment. Keep in mind, the average inflation rate for the last 20 years, going back to 2000, has been just above 2%. And that's why we're talking about this, because this 4.2% is a really high number compared to what we've seen going all the way back to 2008. Social Security, I'm reading another report here, and it talks about the living adjustments. Keep in mind that one of the benefits of cost of living adjustments in Social Security is it should help you a little bit save off or protect you from inflation. But the problem is that now, with the way that things are funded around Medicare, they give us a little bit of an increase on our Social Security. A lot of retirees are actually seeing a reduction in their net Social Security benefits because while they say that they can't raise Social or Medicare premiums faster than Social Security increases, The net result, because of a lot of different things, including like IRMA, income related to Medicare adjustments, those families that are making more money, they can start to actually see a downward trend in the net numbers from Social Security. And here's the real kicker. Going back to 2000, the Social Security benefits, according to the Senior Citizens League, with a 2% average cost of living adjustment, that retirees on Social Security have seen their benefits lose 33% of their buying power, and that's when inflation's been tame. Imagine what that 20% average inflation increase, or what Schiller says could be coming here this year. I think it's a real good opportunity here for us to start thinking about how to bring Social Security, how to bring in inflation into your retirement planning, because it's not just about the investments. Now, investments are one way that we can help keep up with inflation, but it's also about making sure we protect ourselves from market value adjustments. Look at the higher areas that I see inflation, things like taxes, healthcare, long-term care. Let's bring it into your retirement planning. So we know that putting your money in the stock market over the last is one of the best ways that we can guard against inflation. The problem is if I put all my money into the stock market, if I put all my money into the stock market, we run an exposed risk to a recession, or when the markets pull back, and having to lock in games. So it's really about looking for ways that we can help to do that. 4 areas that I think that families need to start thinking about. Number one, let's reduce our tax burden. We are at 40-year lows right now with tax rates. We know that the current tax code is already expected to expire here come January 1st of 2026. The problem is I think that there's a really good chance that we're going to see tax rates even increase as soon as next year. What are areas we're going to see? Well, I think the tax brackets are going to increase. I think we're going to see a major change in capital gains. It's not going to impact just those that are making over $500,000 or those that are making over $1 million. Our average client here at Secured Retirement Financial, I believe, needs to start thinking about what are some proactive ways that we can address our retirement planning. Keep in mind, there's 2 ways to think about retirement planning. One is to be reactive, waiting until things happen and then try to make adjustments. Or what I think is a much better option, let's be proactive. I have no idea how soon tax rates are going higher, but let's start to look and sit down and put together a plan on what the worst case scenario with taxes look like, what's a likely scenario, make sure we can live with the worst case scenario, and then make plans accordingly in your retirement planning. So tax planning, the one thing we can do to stay in front of inflation. In fact, I think it might be the fastest area of inflation over the next 10 to 12 years. Number 2, let's look at healthcare and long-term care planning. Setting aside a certain amount of money that we can start to protect ourselves from the increasing cost of healthcare. Forbes did a study. They said the average 65 couple, married and single, or married couple, average 65-year-old should expect to pay out of pocket an additional $300,000 for a married couple. That's without a long-term care event. That's just what it would cost the average American in retirement from 65 until, whenever, for married couples. We need to start looking at how we can protect ourselves from that, looking at ways to look at long-term care. I'm not a big fan of the traditional long-term care accounts, but if you haven't sat down with us and looked at other options, let's sit down and talk about those. You want to make sure we're protecting ourselves from market volatility while keeping your money invested in the stock market. It's a great way to offset inflation. It's a good way to try to keep up with it. The problem is if we have a pullback in the market, a 10 or 20 or 30% pullback, and you're forced to lock in losses, you may never, especially if there's a rampant increase in the cost of the purchasing things, be able to recover. So we got to protect you from that. The one way to do that is to make sure we don't all have all of our money exposed. Hard to do. We got a 0.1% rate of return on CDs. So let's look at some alternatives. Here's what I'd like you to do. If you are a client of ours, or if you want to spend some time talking about this, if you've already got somebody you're working with, but you just want a second opinion, schedule some time for us to visit. It's what we call our TaxSmart retirement analysis. Again, this is open to anybody. If you're a current client of ours, or if you're somebody that just wants to sit down and let's revisit our planning around inflation. I think it really is about that time that we need to start really getting serious about that. Who knows? I guess let's see what Thursday brings. But I'm a little concerned that we could see some real an additional inflationary number. Good news on that is that all of a sudden maybe we'll get a little bit better return on our savings. The bad news is it could really slow down growth of our investment. So it's not a better time than right now, is what I'm trying to get at, to really bring back inflation into your retirement planning. Best way to do that, schedule a call with us. You can, I just published that, so you can mark that. Give our office a call. The number's right there, 952-460-3260. You can email us at info@securedretirements. Let's see if there's any quick questions here. I didn't see anything. How are you doing, Bill? Not any questions this week. So what we'll do is we'll go ahead and wrap it up. Keep the air conditioning on. It's going to be hot, I guess, for the next couple of days, but it was a beautiful weekend, wasn't it? It was really nice to see that back after a long winter. So I hope everybody enjoys the rest of your week. And again, we're here if you need us. Don't be afraid to use us as a resource. Give us a call. Mark on there that you want to take a few minutes on the phone, or email us, and we'd be happy to be there and help you out if we can. So with that said, we'll be back next Monday with another version of this week's of a market huddle, and we'll see you here in 7 days. Have a good day. Bye-bye.